This is a very timely and important question. Protecting your finances from AI risks means preparing for the economic and job market disruptions that artificial intelligence will cause. Please subscribe to the channel, like, share, comment, and turn on the bell. It's helpful to think about two categories of risk. 1. Systemic risks. How AI could disrupt entire industries and the broader market. 2. Personal career risks. How AI could threaten your specific job and income streams. Here is a strategic approach to building financial resilience against these risks. 1. The foundation. Protect your income and skills, your human capital. This is your single most important asset. If your job is automated, your ability to earn money is directly at risk. Upskill in AI-Complementary Skills. Don't try to compete with AI. Learn to use it. Technical. Prompt engineering. AI tool management, e.g. using ChatGPT, Midjourney, Claude for work. Data analysis, AI ethics and oversight. Human-centric. Skills that AI struggles with. Creativity, critical thinking, complex problem-solving, emotional intelligence, negotiation, leadership, and strategic planning. Cultivate AI-proof traits. Become known for your human touch, ethical judgment, and ability to manage AI systems. Position yourself as the person who leverages AI, not the one who is replaced by it. Diversify your income. Don't rely on a single paycheck. Side hustles. Start a business or freelance in an area less susceptible to automation, e.g. skilled trades, personalized services, creative arts. Passive income. Develop sources of income that aren't directly tied to your time. See investments below. 2. Strategic investment diversification. Your investment portfolio should be structured to not only withstand AI disruption, but also to benefit from it. A. Invest in the picks and shovels of AI. Instead of betting on which AI company will win, invest in the foundational companies that all AI players need. Semiconductors and hardware. AI runs on powerful chips. Companies like NVIDIA, NVDA, Taiwan Semiconductor, TSM, and AMD are critical enablers. Cloud computing and infrastructure. AI models are trained and deployed in massive data centers. The major cloud providers are Microsoft Azure, MSFT, Amazon Web Services, AMZN, and Google Cloud, Google. ETFs. Consider broad technology or specific AI ETFs like AIQ, Global X Artificial Intelligence and Technology ETF, or IGM, iShares Expanded Tech Software Sector ETF, which provide diversified exposure. B. Invest in AI-resistant sectors. Allocate a portion of your portfolio to industries that are less likely to be fully automated in the near future and may even benefit from AI as a tool. Energy and utilities. Physical infrastructure is hard to replace. Think companies in oil and gas, but more importantly, the electrical grid that will power all AI data centers, e.g. XLU ETF. Defense. National security involves complex human judgment and physical assets. Healthcare and pharmaceuticals. While AI aids in discovery and diagnosis, the practice of medicine, surgical procedures, and drug development require deep expertise and human oversight. Skilled trades and real assets. It's very difficult for AI to physically fix a pipe, wire a building, or manage a property. REITs, real estate investment trusts, can be a good proxy. C. Maintain a defensive posture with real assets. Real assets provide a hedge against volatility and inflation that could be exacerbated by rapid AI-driven economy. Gold, a classic store of value during uncertainty. Real estate, tangible property that provides a hedge and potential rental income. 3. Avoid concentration in high-risk sectors. Be critically aware of where you invest. If a significant portion of your portfolio is in companies or sectors with highly automatable business models, you are taking on more AI risk. Examples of higher risk sectors: for equity investment. Routine data processing, certain back office and administrative services, basic customer service, companies reliant on large call centers without a clear AI integration strategy. Low-skill manufacturing, assembly lines that are prime targets for robotics and AI oversight. This doesn't mean you should avoid these sectors entirely, but you should be aware of the risk and ensure your exposure is not excessive. A simple, actionable plan: 1. Career defense, top priority. This month, dedicate 2 to 3 hours per week to learning a new AI tool relevant to your job. This quarter, take an online course on a human-centric skill like leadership, project management, or complex problem-solving. 2. Portfolio defense, core holdings, 60–70%. Keep a solid base in a broad, low-cost S&P 500 index fund, like VO or IVV. These funds hold the large companies that are most actively integrating AI. AI offense, 10–20%. Allocate a portion to the picks and shovels, e.g. an ETF like AIQ or a basket of MSFT, NVDA, etc. AI defense, hedge, 10–20%. Allocate a portion to AI-resistant sectors like healthcare, XLV, utilities, XLU, and real assets like gold, GLD, or real estate, VNQ. Key mindset. The goal is not to panic and put all your money into crypto or AI startups. The goal is prudent, intelligent diversification. You want to own the companies that are driving the AI revolution, while also protecting yourself from being displaced by it. Of course, it's important to understand what you're protecting yourself from. A weaker US dollar, higher inflation in the US, increased volatility in global markets, a shift in global economic power. Protecting yourself isn't about doomsday prepping, but about prudent, diversified financial, a simple, practical plan to get started. You don't need to do everything at once. A simple, layered approach could look like this. 1. Layer 1, foundation. Be debt-free with a solid emergency fund. 2. Layer 2, basic diversification. In your investment portfolio, e.g. your IRA or 401k, have a significant allocation to international stocks, e.g. 20 to 40% of your stock allocation. 3. Layer 3, inflation hedge. Allocate 5 to 10% of your portfolio to a mix of gold, via an ETF, and real estate, via REITs. 4. Layer 4, speculative, optional. If you have the risk tolerance, allocate 1–5% to cryptocurrencies like Bitcoin, understanding it's a high-risk bet. What to be careful of? Do not put all your money into gold, crypto, or a single doomsday asset. This is just as risky as having everything in cash. Avoid gurus selling fear. They often promote specific high-commission products that benefit them, not you. Focus on time-tested principles. Diversification across asset classes, geographies, and currencies is the key to managing any systemic risk. Disclaimer: this information is for educational purposes only and should not be considered financial advice. Please consult with a qualified financial professional before making any investment decisions. Subscribe, like, comment, and share.